The myth of set it and forget it is perhaps the most dangerous financial lie of the 21st century. For 30 years, this was the golden rule of American retirement planning. You signed your onboarding papers at a new job, you ticked the box for a target date fund labeled 2040 or 2050, and you assumed that a group of very smart algorithms in a skyscraper would handle the rest. The logic was simple. The markets always go up over time, diversification is a free lunch, and geopolitical noise is just that, noise. But as we sit here in 2026, that logic hasn't just aged poorly, it has become a liability. We are no longer living in the era of the Great Moderation. We are living in the era of the Great Realignment. Passive investing worked beautifully when the world was globalizing, when energy was cheap, and when central banks could print their way out of every shadow of a recession. In that world, geopolitical stability was a constant. In 2026, geopolitical volatility is the variable that determines whether your account grows or slowly bleeds out through hidden inflation and stagnating assets. When you forget your retirement account, you aren't just ignoring your money. You are ignoring the fact that your fund might be heavily invested in a semiconductor supply chain that is currently being weaponized, or in sovereign debt from nations that are decoupling from the Western financial system. Today, we are performing a full audit. We are going to stress test your assumptions. Because in an active geopolitical era, passive management is a slow-motion disaster. It is time to move from being a passenger in your retirement journey to being the navigator. If you look at your statement today, you likely see a section labeled Fixed Income or Bond Funds. In the traditional 60-40 portfolio, 60% stocks for growth and 40% bonds for safety, those bonds were supposed to be your shock absorbers. When stocks went down, bonds were supposed to go up. But over the last few years, we've seen something terrifying. Positive correlation. Stocks and bonds falling together. This is happening because of what I've previously called the cash quarantine. Central banks globally have been forced to keep interest rates higher for longer to combat structural inflation. Inflation driven by the end of cheap labor and the end of cheap energy. When rates stay high, the safe bonds you bought years ago at 2% are worth significantly less on the secondary market because new bonds are yielding much more. Your safety net is actually a hole in your pocket. Inside your retirement account, those bond funds aren't just holding U.S. treasuries. They are holding corporate debt and international sovereign debt. In 2026, we are seeing the rise of fragmented liquidity. Certain currencies are being quarantined, effectively blocked from the global dollar clearing system. If your bond fund has exposure to emerging market debt in regions that are currently pivoting toward competing economic alignments, you are holding assets that are effectively frozen or devaluing against the dollar. Your provider won't send you a red alert email about this. They will simply list it as a minor dip in the International Bond Index. But that dip is a permanent loss of purchasing power. The problem with total bond market funds is that they are weighted by debt. This means the more a company or a country borrows, the more of your money goes into their bonds. You are systematically rewarded for lending money to the most indebted actors in a high-interest rate environment. You are funding the past, not the future. If you are between the ages of 45 and 60, you have been told to increase your bond allocation to reduce risk. I am telling you that in this geopolitical climate, a blind increase in traditional bond funds may actually be increasing your risk. You are trading the volatility of the stock market for the guaranteed erosion of your principal in the bond market. Now, let's get practical. You need to log into your portal and download the prospectus or the fact sheet for your 3 largest holdings. Most people see a wall of text and close the tab. Don't. We are looking for zombie assets. A zombie asset is a company or sector that only survives on cheap credit and global stability. 2 things we no longer have. These are the sectors most vulnerable to the supply chain friction we have been tracking. Look at the top holdings of your equity funds. You are looking for 3 red flags. First, overexposure to just-in-time manufacturing. If your fund is heavily weighted in companies that rely on single-source components from volatile regions, you aren't diversified. You are a hostage to a naval blockade. Second, check for high debt-to-equity ratios. Companies that need to roll over their debt are hitting a wall. If your fund is heavy on companies that haven't turned a profit yet, you are holding zombies that are about to be eaten by interest rates. Third, look for portfolios hollowed out by restrictive social and governance mandates. While the intentions were noble, many of these funds completely stripped out old energy like oil, gas, and nuclear. In 2026, as the world experiences an energy realignment, those old energy assets are the only things keeping pace with inflation. If your account is 0% energy, you are missing the most important hedge of the decade. We have discussed the great decoupling extensively, but your account might still be doing the great coupling. Check your international or emerging markets fund. Many of these funds still have a high weighting in technology and state-owned enterprises from regions currently in direct conflict with Western interests. In 2026, with new transparency acts and the risk of secondary sanctions, these assets are essentially untradeable in a crisis. If your fund manager hasn't reduced this exposure, you are paying them a management fee to hold a ticking geopolitical time bomb. You need to ask yourself why you are holding a total world index when the world is currently splitting into two distinct, competing economic blocks. So, what does a geopolitically hardened retirement account look like? It moves away from passive indices and toward resilience. We are looking for sectors that are inflation-hardened and friction-resistant. The first pillar is the real asset tilt. In your account, you often have access to natural resource funds or real estate investment trusts. In 2026, these are no longer alternative investments. They are your core. Look for infrastructure funds that own the bridges and pipes, companies that own energy terminals, water systems, and telecommunications. These have inflation linkage, meaning they can raise their prices as the cost of living goes up. Agriculture is also critical. The geopolitics of food is the story of 2026. Funds that invest in the supply chain of fertilizers and large-scale agricultural tech are your best defense against a weakening dollar. The second pillar is the Self-Directed Brokerage Option, or SDBO. This is the most important piece of tactical advice I can give you. Look through your plan documents for this option. Most employers don't publicize it because it's more work for administration, but the majority of large plans have it. This allows you to take a portion of your money and move it out of the limited menu of mutual funds and into a wide-open brokerage account. With this option, you can buy specific sector ETFs like defense, cybersecurity, or nuclear energy. You can buy treasury bills directly. Instead of a bond fund that is losing value, you can hold short-term bills that pay you a high yield with zero market risk. If your plan offers this, you are no longer trapped in the zombie funds your employer chose years ago. You can pivot your retirement toward the current reality. The third pillar is defense and reshoring. Your account should reflect the return of the factory. Look for industrial funds that focus on North American automation. As companies pull their manufacturing out of unstable regions and back to domestic soil, the companies providing the robotics and the smart factory software are the new growth engines. This isn't speculation. This is following the literal path of the capital. The government is subsidizing this transition through massive infrastructure and technology acts. If your account is still betting on global consumer discretionary goods, you are missing the greatest industrial shift in 80 years. I know what some of you are thinking. You might feel you don't have time to be an analyst. My answer is simple. If you don't have time to watch your money, the world will have plenty of time to take it from you. The set it and forget it era was a historical anomaly. It was a period of peace and low inflation that allowed us to be lazy. That era is over. The insight I want to leave you with today isn't a specific stock tip. It's a mindset shift. Your retirement account is not a savings account. It is a strategic reserve. It is the capital you will need to navigate a world where the cost of energy, food, and security is structurally higher. Identify your zombie assets, check for the self-directed option, and pivot toward resilience. The mission of this program has always been to give you the clarity to act when others are paralyzed by the headlines. Don't let your retirement be a casualty of a war you didn't know was happening. Your retirement is your responsibility. Stay sharp, stay informed, and I'll see you in the next briefing. The transition from a passive to an active investment strategy requires an understanding of the underlying mechanics of global power. When we look at the traditional retirement structures of the late 20th century, they were designed for a unipolar world. In that world, the U.S. dollar was the undisputed reserve currency, and the U.S. Navy guaranteed safe passage for trade in every corner of the globe. This created an environment where companies could source parts from 10 different countries, assemble them in an 11th, and sell them in a 12th, all with razor-thin margins and zero inventory. This was the era of efficiency. But efficiency is the enemy of resilience. In 2026, we are trading efficiency for security. This means that the companies that used to be the darlings of your 401k, those that mastered global arbitrage, are now the ones with the most fragile earnings. When a single geopolitical flare-up in a shipping lane can halt production for 3 months, a company's price-to-earnings ratio becomes secondary to its supply chain geography. The audit you must perform involves looking at the geographic footprint of your holdings. It is no longer enough to know that a company is based in the U.S. You must know where its factories are and where its customers live. If a major portion of a company's growth is tied to regions that are increasingly hostile to Western capital, that growth is at risk of being stranded. This is what we call jurisdictional risk. It is a concept that used to be reserved for mining companies in unstable territories, but in 2026, it applies to almost every sector. Your retirement funds are likely full of these hidden risks because index funds are blind to geography. They only care about market capitalization. Furthermore, we must address the issue of monetary debasement. When governments are forced to choose between supporting their domestic industry and maintaining the value of their currency, they will almost always choose the former. This leads to a persistent, structural inflation that traditional bond funds are not equipped to handle. In your audit, you must look for assets that possess pricing power. Pricing power is the ability of a company to raise prices without losing customers. In an inflationary environment, this is the difference between a portfolio that grows and one that merely survives. Utilities, essential technology providers, and high-end industrial manufacturers often possess this power. Your standard target date fund often dilutes these high-quality assets with thousands of weaker companies that will see their margins compressed to zero. Finally, consider the psychological barrier of the audit. Many of you have been told for decades that individual investors cannot beat the market, and that any attempt to manage your own account will lead to ruin. This advice was designed to keep you paying management fees to the very institutions that are currently holding these zombie assets. While I am not suggesting you become a day trader, I am suggesting that you become an informed owner. The 401k was sold to the American public as a way to democratize wealth, but it only works if the participants are actually involved. If you remain passive, you are essentially giving your proxy to a system that is currently misaligned with the new geopolitical reality. Taking control of your account via the self-directed brokerage option isn't about outsmarting the market. It's about opting out of the sectors that are no longer viable in 2026. It's about ensuring that your 30 or 40 years of hard work are not evaporated by a structural shift you saw coming, but failed to act upon. Your retirement is the ultimate prize in this era of competition, and it is up to you to defend it. To deepen your audit, you must understand the concept of the scarcity premium. In the previous decades, we lived in a world of abundance. Abundance of labor, abundance of energy, and abundance of capital. Today, every one of those factors is in retreat. Labor is becoming more expensive as demographics shift and populations age. Energy is becoming more expensive as we move away from high-density fossil fuels toward a more fragmented and complex energy mix. Capital is becoming more expensive as interest rates return to historical norms. This means that assets that control the sources of these things, the mines, the power plants, the skilled labor pools, will command a premium. Most 401k menus are heavily weighted toward companies that consume these resources rather than those that produce them. By shifting your perspective toward the producers, you are positioning your retirement to benefit from the very forces that are hurting the rest of the market. This is the essence of stress testing. You are looking for the point of failure in the system and ensuring your capital is on the other side of that point. The audit is not a one-time event. It is a recurring process. The world moves fast, and the alliances of today may not be the alliances of next year. By engaging with your account now, you are building the muscles required to navigate the rest of this decade. You are moving from a state of financial anxiety to a state of financial agency. And that agency is the most valuable asset you can own in 2026. The myth of set it and forget it was a comforting fairy tale, but the reality of the 401k audit is a call to action. Take the documentation, do the research, and make the pivot. Your future self will thank you for the work you do today. In the final analysis, your 401k is a reflection of your worldview. If you believe the world is returning to the stability of the 1990s, then by all means, stay passive. But if you see the world as I do, a place of increasing friction, realignment, and competition, then your current portfolio is likely a mismatch for the reality on the ground. The audit is your opportunity to correct that mismatch. It is your opportunity to ensure that your wealth is tied to the sectors that will build the world of 2030 and beyond, rather than those that are clinging to the ghost of 2019. The friction we see in the supply chains is not a temporary glitch. It is the new baseline. The inflation we feel is not transitory. It is the cost of rebuilding a domestic industrial base. These are the macro trends of our lifetime. A retirement account that ignores them is not a retirement account. It is a gamble. We have spent years discussing these geopolitical shifts on this program, from the rise of new trade corridors to the weaponization of finance. The 401k audit is simply the application of that knowledge to your personal bottom line. It is the bridge between global analysis and personal security. You have worked too hard and too long to let your legacy be decided by a default algorithm that doesn't know the difference between a resilient supply chain and a fragile one. You have the tools, you have the information, and now you have the plan. The era of passive retirement is over. The era of the active, informed participant has begun. Use the self-directed options available to you. Identify the assets that are no longer serving your long-term interests, and align your capital with the reality of the 21st century. This is how you protect your family. This is how you protect your future. And this is how you win in the era of the Great Realignment. Remember that the institutions managing these funds are often the last to change. They are built on inertia. They will continue to recommend the same products and the same allocations long after they have ceased to be effective because change is expensive and risky for them. But you do not have that luxury. Your risk is not institutional, it is personal. If your account drops by 30% and stays there because of a structural shift in the global economy, the fund manager still gets paid, but your retirement plans are ruined. This is why the audit must be driven by you. You are the only one with 100% stake in the outcome. As we close this briefing, I want you to look at your retirement portal one more time. Don't look at the balance. Look at the holdings. Look at the names of the companies and the types of bonds. Ask yourself if those assets are prepared for a world of 5% interest rates, restricted trade, and constant geopolitical tension. If the answer is no, or even if you aren't sure, then the audit has already begun. The first step is awareness, the second is analysis, and the third is action. You have the awareness. Now, perform the analysis and take the action. This is the mission of Insight with Sarah, and it is the mission of every successful retiree in the years to come. Your retirement is your responsibility. Do not forget it, and certainly do not set it and forget it. Stay sharp.